as they relate to the oil and gas industry. I think that's why I was invited. Otherwise, I'm not a tax expert. But you can also tell that even from the discussions I've had from Ben, the very, very, probably the most experienced budget personnel we have in Nigeria, you realize he ran the budget ministry in Lagos State for 12 years after being a bank CEO before going to the federal government to run the budget. I don't think you get more experience than that. And also from the FIRS executive chairman. It is clear to me that there are some key issues about taxation and the oil and gas industry that are grossly misunderstood. You have seen from all the presentations a steady decline in revenue collections, tax collections, even when you have increases in oil prices. And I noticed from the executive chairman of FIRS that the blame goes to tax defaulters, which is the easy part of it. Let me quickly explain to you how it works, especially with reference to the just passed Deep Offshore Act, which impact is to increase revenue collection from deepwater revenues. In 1993, when the Deepwater Act was passed, oil price was $16 per barrel. Royalty in excess of 1,000 meters was 0. And it graduates up to 100 meters, about 12%. Nominal technical cost for operating in that region was $3.50 per barrel. And the way our industry works is a very, very simplified tax system. It's gross revenue, take out royalty, take out costs, and then FIRS will slam the tax on you. It's as simple as that. So when that act was passed and you add the royalty and cost, it amounted to about 28% of gross revenue. So that was the total deduction before you talk about tax. And therefore, the after-tax margin available to both parties, both government and its contractor, was 36%. Generous margin. And you can imagine that margin then increases rapidly if oil price went further than $16. By 1998, oil price had declined to about $9 per barrel. Everybody was panicking. So you can also understand why there was a proviso that when oil prices exceed $20, let's sit back and renegotiate this contract. So all of us had seen a lot of changes at government level, NNPC in particular. GMDs change almost every 2 years, 3 years, the Director of Petroleum Resources. So you didn't have the continuity for enforcing that clause, that let's sit down and renegotiate when oil prices were heading towards $100. And then the industry, therefore, enjoyed that windfall profit over that period. So by the time in 2019, government, almost more out of anger, then sat up and say, this clause has been here for over 20 years, we haven't renegotiated. They didn't bother to consult the industry. They went ahead and adjusted it themselves, more out of anger. So today, they have introduced royalties in deep water, minimum of 10%. The big elephant in the room is that at the time you were adjusting the royalty, technical cost had gone up from $3.50 to $25 per barrel. So after the adjustment in 2019, which they just did, let me read out the real figures for you that I just computed yesterday. So even though oil prices have gone from the $16, the basis of which that fiscal computation was done, to $60 in 2019, because cost had gone to $25 per barrel, and you had reintroduced royalties between 10 and 15%. The royalty plus cost, which I showed earlier to be 28%, between 22 and 34%, is now 54%. So that's your deductible before you slam the tax. The implication, therefore, is that I want to be very clear about the actual figures so I don't mislead you. So royalty plus cost had gone up from 28% to 54%. And therefore, the after-tax margin, even at a higher price of $60, had shrunk from 36% to 18%. You may say it's still a generous margin, but just to tell you the implication of that adjustment without taking care of the elephant in the room, which is cost. So the contractor margin then shrunk to between 11 and 16%. And that's at $60. At $50, the contractor margin shrinks to 9.5%, depending on your royalty rate, between 9.5 and 13%. And we can say what we like. The thing about taxation is the judgment will eventually come by the flow of funds. If a tax regime is good enough, you will see inflow of capital. If it is not good enough, you will see capital flight. Almost consistently over the past 10 years, when we draw up our budget on assumptions of oil production, we have never met any of them. We can give all the excuses. If you do not invest in this industry, you will not achieve the production projections that you are basing your budget on. 15 years ago in this country, we were aspiring to do 3 million barrels a day and a reserve of 30 billion barrels. That was the mantra. Nobody talks about it anymore. We are doing 1.96 million barrels a day because deep water, where the tax collection is minimal, again, because of what I just read out, royalty almost zero, tax rate 50%. The real tax collection is in the traditional basin, where tax is 85%, royalty is 20%. By 1993, that traditional basin was doing 2.2 million barrels a day. We're still aspiring to do 2 million barrels a day because deep water does 1,800,000 barrels. If you back out deep water production, the traditional basin production that was 2.2 million barrels a day 20 years ago is barely 1 million barrels a day today. And that's where the huge tax collection comes from. Because there has been no investment in this traditional basin, our production is less than half of what it used to be 20 years ago. So as I said, and I'm going to pass this microphone over, just to note one thing. Our revenues will come from three things. First, gross revenue is production times oil price. Oil price we have no control over. It can be $20, it can be $100. If you have a flexible taxing schedule that makes provision for increases or reduction in oil price, and if all of us pay attention to the big elephant in the room and nobody does, which is costs, then you have a taxable margin that is healthy enough for everybody to benefit from, both those who are investing and those who are collecting the revenues. It's oil price times production. That's the gross revenue. You back out royalty, yes, government can increase royalty. You back out costs. So tax rate is not necessarily the big incentive for government to get more money. You can increase tax rates to whatever you want if there's no taxable revenue to tax. From the calculations that I just did, at $30 per barrel cost that we're now approaching, if oil price is $50 in traditional basin and you back out 20% royalty, you are left with $40 before backing out costs. If you back out $30 cost, you can use 95% tax rate. It doesn't matter. There's very little to go to FIRS. So until we start paying attention to the big elephant in the room, and I think Ben mentioned it, we were doing $2 per barrel when we wrote the MOU 1986 to 1990. That was nominal technical cost in the traditional basin. Today it's $25 per barrel. We spend oil transportation, the pipelines, That used to be like 50 cents per barrel. It's more like $5 per barrel today. Reason? All your security issues. So when you award at federal level those huge security contracts to watch the pipelines for us, somebody is paying. When all the contracts go up because you can't get people to work in the Niger Delta, somebody is paying. When you sum up all of the costs, when different agencies come in and slam all kinds of taxes on them, they are all going to end up as costs that are deductible. So the point is, if we don't pay attention and bring costs back to manageable levels below $15, $12 per barrel, increasing tax rate or increasing royalties can only do two things. Net effect is you don't collect more. The further net effect is you drive away investments. That then makes it even worse for you to collect because production will decline. Thank you.